Thanks for clicking. Regardless of supply constraints, if people can't afford to buy real estate, they won't buy it. This according to Basic Logic and Bank of Canada Governor Tiff Macklem during questioning yesterday at the Parliamentary Finance Committee.
People obviously need shelter, but if they can't afford it, they can't buy it.
You don't know.
Not so fast. The governor also said that the Bank of Canada might not have to wait until inflation is back down to 2% in order to cut rates.
Boy, that's just a straight shooter with upper management written all over.
The appearance before the Finance Committee comes amid a new, widely publicized report coming from RBC saying that if interest rates don't come down by 2025 and 2026, Canadians, especially those with variable rate mortgages but fixed payments, are in for a real payment shock. The governor, as well as Deputy Governor Carolyn addressed the report from RBC, as well as a barrage of questions related to inflation, when we can expect interest rate cuts, government spending, rising bond yields, and the real estate market during its appearance at the Parliamentary Finance Committee. So what I want to do today is go over the governor's appearance before the committee, take a look at what he had to say about government spending, rate cuts, inflation, and the real estate market, and then discuss what to look for next. Today is the last day of the month, and with that, we are eagerly awaiting the release of October's real estate data from the local boards, which should be coming out in the next couple of days. We'll obviously have an update out on that data on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into this interview. On to the governor's appearance. First up, government spending, as Governor Macklem was asked multiple times if government spending was in fact pushing up inflation.
Is that helpful in you bringing down the interest rate? Yes or no?
And while the governor appeared to be more forthcoming during this interview than he is during press conferences, he was definitely no less annoyed.
I'm not going to have yes or no answers when you get down to specific questions of fiscal policy.
Okay, but...
Hate it!
With that said, the governor did note that although current spending plans aren't exactly inflationary, future spending plans, the plans for 2024, could in fact push up prices.
All those plans are realized, then yes, there's a risk that fiscal spending will increase more than supply, and that won't help to reduce inflation.
The governor was later on pressed on government spending by a Conservative MP and was quick to note that it's spending at all levels of government that is a concern for inflation.
I think in that for all levels of government, looking forward, I think given that inflation continues to be above its target, I think more focus by governments on the spending, the inflationary consequences of their spending decisions would be helpful.
So, the message coming from the bank, if governments were more aware of inflation when they were making their spending decisions, then the bank could cut interest rates. Shortly after that, the governor was again pressed on the fiscal position of the federal government and the provincial governments, to which the governor politely declined.
No, I'm not going to comment on the fiscal positions of every province.
No, that's okay. That's no problem.
No, I'm not going to be your monkey. Go ahead.
Next, the part that made major headlines and will no doubt be included in every real estate forecast that you'll see from now on. The governor was asked when the Bank of Canada will be cutting interest rates.
What would you tell my constituents about when are interest rates going to come down?
For her part, the deputy governor was the one to light the match, saying that the bank doesn't have to wait until inflation reaches target in order to cut rates. If it sees inflation coming down sustainably to 2%, then it can cut rates early.
If we get signs that we can be confident that inflation is coming down and will remain down, we would start thinking about lowering interest rates.
So, while the bank has said that it doesn't expect the CPI to get back down to 2% until 2025, Deputy Governor Rogers says that if inflation looks like it's getting there, that it's going to be there by 2025, then the bank can cut rates ahead of time.
You have one day.
With that said, the Deputy Governor stressed the part that will be omitted by real estate forecast, I'm already seeing it less than 12 hours later, that inflation has to come down first.
So we don't need it to come all the way back to target, but we need to be confident that it's on its way to being sustainably back to its targets.
Speaking of borrowing costs, the governor and the deputy governor were also asked about rising bond yields in the U.S. and in Canada, and if increased government borrowing is causing yields to rise.
And I quote from last week's presser, the U.S. deficit means a lot more bonds being issued, meaning increase in supply has to be absorbed, and that pushes prices up a bit. The U.S. is doing $2 trillion this year, Canada doing $421 billion. That's a record, and no one is talking about that. And no one is talking about that having a contributing factor interest rates.
For her part, the Deputy Governor said that yields in Canada aren't rising as fast as they are in the United States, but was then cut off shortly after admitting that government borrowing was contributing to higher yields.
We're not seeing that same increase in Canada. We haven't had the same effect of
the 5-year. With respect, the 5-year moved up a bunch of basis points, and without the policy rate moving.
Yep, and there's a number of things contributing to that. It's
including the government borrowing.
That's the time. Yeah, thank you.
And I think this is a decent point. We've talked before on this channel at great length about U.S. borrowing costs sending our own borrowing costs higher. With Treasury yields going up and Canadian bond yields going up thereafter, Canadian mortgage borrowers now have to compete with the U.S. for money in the market, sending our interest rates higher. But Canadian mortgage borrowers are also competing with the government for market money as well. The government, which is set to borrow $172 billion worth of bonds this year, with another $202 billion in Treasury bills. So, when the government has to borrow money, when the government has to borrow new money to pay back old money, just like you and I, they're competing with you and I as well. And since the government is seen as less risky than you and I when they borrow more money, it pushes up the cost of us to borrow money.
Don't talk to me.
Finally, housing, which was supposed to compose the second half of the appearance before Parliament. The governor was asked directly if Canada is currently in a housing bubble.
Is Canada currently in a housing bubble?
For his part, the governor didn't really answer the question, but did note that the housing market is better off than it was before.
Prices have gone up 50% in this country, and with the increase in interest rates, the housing market is now better balanced. The interest rate hikes have had a very quick effect on demand. It has driven demand down, and so now the market is better balanced than it was.
Could have been worse.
So, the big news coming out of the appearance before the Finance Committee is that the bank is continuing to warn of fiscal spending putting upward pressure on inflation, but is also saying that the bank can in fact cut rates before inflation is back down to 2%. I'm not sure if this was a misspeak on the part of the Deputy Governor or what it was, but it's definitely a departure from the hawkish tone that we've been hearing from the Bank of Canada for at least the past few months, where the bank has almost outright refused to even hint that interest rate cuts could be on the way anytime soon. With that said, the bank can say whatever it wants right now. Forces far, far beyond the Bank of Canada's control are running the show. With growing problems abroad and yields gyrating up and down for the past few weeks, the future of interest rates is definitely uncertain. We've been seeing prediction after prediction saying that rates are coming down in the next 3, 6, 9 months. But the reality is that until we know how events abroad are going to play out, absolutely zero people on Earth can make any sort of accurate prediction as to where the economy is going to be in 6 months. We don't know what's going to happen with energy prices. We don't know what's going to happen with U.S. borrowing. We don't know what's going to happen with Treasury yields or Canadian government bond yields. The reality is we just don't know. This isn't like the beginning of 2022 when inflation was running at 4 and 5% and we knew interest rates were going to go much, much higher than the zero that they were at the time. Interest rates are already in a restricted territory, but we have a great, big, massive black swan event that could push inflation up much, much higher than it is. We just don't know how all of this is going to play out. With that said, we will continue to track Canada's real estate market and how the Bank of Canada responds to global events and to our own economy on this channel. Click like and subscribe if you want to get those updates, but for now, thanks so much for watching.